When it comes to the tensions surrounding trade, there's certainly no shortage of attention-grabbing headlines, especially around the on-again, off-again tariffs. Even so, TSX still managed to track higher, up roughly 7% year-to-date. Here to tell us what's going on in the market, Jennifer Nowski, Managing Director and Portfolio Manager at TD Asset Management. Jennifer, welcome back to the program.
It's good to be here.
All right, so it's interesting. We're almost at the halfway point of the year. We've had a lot of drama, all this uncertainty, tariff threats, but the TSX has still been performing quite well. What is happening here?
Yeah, so the TSX has had a good start to the year. And while those returns have been led by materials, in particular the gold sector, if you dig into the TSX, you'll see that the returns are more broad-based, with nearly all sectors either flat to up year to date. Now, if we take a step back and look at how the market has developed over the course of the year, the TSX had some volatility earlier on in the year when Canada and Mexico were called out earlier for the tariff discussions, we'll say. But the TSX, along with global equity markets, really sold off in April after that April 2nd reciprocal tariff announcement. However, the markets broadly bounced back quite strongly when it became apparent that Washington was willing to either negotiate or delay some tariffs. And now it appears that tariffs levels won't be as punitive as initially feared. So looking at the valuation on the TSX, it's currently trading at about 16.7 times 2025 earnings. That's roughly in line with its historical average. Earnings expectations for the market, for the Canadian market, they have been brought down by about 3% since the beginning of the year, and that reflects some of that economic concern weaving its way into earnings. However, earnings growth for 2025 is still expected to be about 7% for the Canadian market. And while the materials sector is a big contributor to that, most of the other sectors are either flat to slightly up. The other important backstop for the Canadian market is really the credit quality of the companies. So looking at big components of the market like financials or resources, some of the major players across the industrial, IT, and consumer space, they're sitting with good balance sheets, and that allows them to withstand any weakness they may see or continue to maintain their investment levels and returns to shareholders.
Sound fundamental reasons to explain what we're seeing on that chart there in terms of the rise of the TSX. All this news around tariffs, I think it creates a lot of uncertainty, worries about the economy. But what do we actually know right now about the impact on the Canadian economy, the real impact?
So the tariff situation is still very fluid. I'd say in terms of what the real impact has been thus far, has been in the potential pull forward of demand, which you see in some key economic indicators, as well as the volatility around sentiment. So starting with that pull forward of demand, it's apparent from Q1 GDP from the US that imports spiked in Q1, and that's since reversed. It's also in more micro indicators like US auto sales. They were very strong in March and then reverted back. The tariffs also caused some volatility in sentiment, with consumer sentiment and business sentiment pulling back in April. While there's been some rebound, I'd say there's still some lingering questions if just the ongoing negotiation of tariffs creates enough uncertainty that it slows business investment and economic activity. Now, looking at consensus forecasts for Canada and US GDP growth in 2025, they're kind of starting to converge. So if you start with the US, the U.S. economy grew 2.8% in 2025. 2024, sorry. It was actually a strong year last year. This year, economists are expecting that to decelerate to about 1.4%. Turning to Canada, 2024 was a weaker year for Canada. Growth was slower at 1.6%, and unemployment was rising. Now, with these tariff negotiations, growth in Canada is expected to remain at the lower end at about 1.2%. And really, while most Canadian goods are exempt from tariffs under the USMCA, there's still some headwinds due to the sectoral steel and aluminum tariffs, as well as parts of autos. That could be headwinds for the Canadian economy. Now, there are also potential offsets. The Bank of Canada, of course, had been on a rate-cutting cycle through most of last year. And although they paused at their most recent meeting, if the economic growth were to slow further, you could see them resume cuts. As well, there might be fiscal offsets. So Prime Minister Carney is appearing to take a more pro-growth stance and is looking at initiatives to promote interprovincial trade, the development of large projects, and labor mobility.
When I think about the economy and trying to read the tea leaves of it, I often look to the financials and what the Canadian banks are saying, because they have to have a forward view of sort of what's happening. What did we actually learn from the results a couple of weeks ago?
Yeah, so the Canadian banks, you're right, did report a few weeks ago, and generally the operational results were quite good, and there continues to be a close eye paid to the development of credit for the banks. So turning to the positives, the banks generated good organic pre-tax, pre-provision growth up in about the mid-teens year over year, and that is reflective of good expense control and also stronger growth in areas like wealth and capital markets, the latter of which really benefited from stronger trading activity due to that market volatility. The Canadian banks are still sitting on very good capital levels with common equity tier 1 ratios above 13%, and this has supported dividend growth and buybacks amongst the members of the group. Now, the area investors have been watching quite carefully is the development of credit. And credit came in roughly in line this quarter. It was positive to see impaired provisions for credit losses tend to flatten out quarter over quarter. However, the banks did cite slowing macroeconomic conditions for taking up their performing PCLs. Now, if I think back to the beginning of the year, investors were debating when the Canadian PCLs would start to level off. Perhaps with some of the concerns around the economy, that timeline's been pushed out a little. However, when you look at bank valuations, the banks are trading fairly close to their average price to book. They're a little higher on price to earnings, but bear in mind that earnings number is being weighed down by some of these PCLs.
Interesting stuff in the banks there. You mentioned dividends and buybacks at the banks. What other parts of the Canadian market start to look interesting if someone's looking for dividend growth?
Yeah. So when you're looking for dividend growth, you want to find companies that have good opportunities to grow their free cash flow and the financial flexibility to both invest in the business and continue to return cash to shareholders via that dividend. Now, there tends to oftentimes be a trade-off between very high dividend growth, but also having a lower dividend yield. So an area like, say, the consumer sector, many different companies in that sector, but you sometimes see high dividend growth, but that low yield. Whereas the traditional higher dividend yielding sectors like utilities, telecoms, and REITs have very low dividend growth. Now, one area that we find has a balance of both is the financial sector. So the financials, we talked about the banks being well capitalized. The other big part is the life cos, and they're similarly sitting on excess capital, continuing to grow earnings and their dividend, and also buying back shares. So overall, the TSX financial sector has a dividend yield of about 3.3%. That's above the TSX composite. And they've been growing their dividends over the past year at about 7%.